The general public right now is tapped out. They have huge amounts of credit card debt. It seems like this is unsustainable. I mean, where do you see this going? Because you can't just continue to borrow credit card debt. I mean, the interest rates are incredible on those. So this is definitely not something that can go on forever.
Well, and it's not just the ability of the average household's capacity to take on more debt to keep spending, but there was a bank officer's loan survey that was released, I think, last week, either last week or the week before. And banks are tightening down on their issuance of credit, because I think and this is just, we went through this back in 2007, 2008. I mean, and we started to go into it at the end of 2019. And if you look at a lot of the numbers that I was looking at the delinquency rate on auto loans, and right now it's higher than it was at the peak of the great financial crisis. But it was starting to get up to where it is now back in late 2019, and the pandemic gave the Fed an excuse to print over $3 trillion all at once. And that's basically what saved the economy. And the economy was going to tank regardless of the pandemic lockdown or not. It was headed that way. All the data showed it, housing sales, et cetera. So it's the banks are looking at this, delinquency rates are going up, and it's not just auto loans, mortgages, delinquency loans rates are going up. When I said the delinquency rate of auto loans, I mean, referring to subprime auto loans, because it's become a pretty high percentage of total auto loans. And to be frank, what was considered what's considered subprime now would have been absolute nuclear garbage in the great financial crisis, because lending standards were loosened up so much, especially on mortgages by the FHFA, that there's a certain percentage of loans that are issued as prime rated credit loans, but they're not really. They would have been stamped subprime, 15 years ago. So like I said, banks are looking at this and they're saying, whoa, we're looking at charge-offs, we're looking at loan losses. We gotta tighten down on who we're willing to give money to, and that's what's going on right now.
So are you saying with mortgage lending, the standards are even lower than they were before the 2008 crisis?
I'm not referring, we obviously don't. Well, I think there are some private mortgage vendors that are doing 110, 120 loan to value loans. They're certainly doing ARMs again. 0% down mortgages. There's hedge funds that were funding that during the tail end of of this current housing bubble. But if you look at the conforming loan is an agency guaranteed loan, Fannie, Freddie, Ginnie Mae, and there's a certain down payment requirement. There's a certain debt to income ceiling, and so down payment, debt to income, and credit rating. So first of all, we know that FICO loosened up its credit rating standards. All right. So, if something below 620 is subprime. Okay. Well, today's 620 FICO is not the same as a 620 FICO in 2005. The person with a 620 FICO in 2005 had a better credit than does that make sense? Than the person with a 620 FICO today. So someone with a 630 FICO would have been called subprime back in 2005, and that's just one part of it. Back then, the down payment requirement for a conforming mortgage, I believe it was 5%. It might have been as high as 10%, but the FHA started lowering that requirement. I think starting in 2015, they loosened up the requirements to qualify for a conforming mortgage. And now you just have to put down a 3% down payment. And in a lot of cases, I could borrow 3% for the down payment from you, right? And then if I qualify in every other respect for a mortgage, I get that mortgage. They don't care that I owe the 3% back to you. That wasn't allowed back then, although I'm sure it was going on. And then the debt to income ratio. Originally, the debt to income ratio was 40%. What that means is that, including the mortgage, your total monthly interest rate nut on all the debt that you have can't exceed 60% of your gross income, right? So the income on a monthly basis that you report to the IRS. And now they raised it to 60%, I don't know, 2017, 2018 maybe. And then during the lockdown period, when we had the debt moratoriums, they removed the debt to income limitation. So it may be back in there right now. I have to look it up. But the point being is that a lot of the conforming mortgages that have been issued, say over the last, well, really since 2015, would have been considered subprime, even though they weren't like the garbage countrywide 125 LTV non-document loans, non-income verification loans. But they would have been considered subprime in terms of the credit quality and the profile of the borrower. So that's why, it doesn't matter that we don't have the liar mortgages and, that garbage anymore. But, on average and in general, the overall credit quality of the pool of mortgages in total economy wide is lower than it was back then.